Another volatile day today in the markets. A CPI rose yet again, now to 7.9%, the highest again in 40 years. The inflation train just doesn't stop running. Bill Baruch joins us now. He is the president of Blue Line Futures. Bill, welcome back.
Thanks for having me on again. It's always a pleasure to join you.
Always a pleasure to have you on, especially during days of extreme volatility. Stocks are down 1.1%, the S&P 500 I'm talking about. Last I checked, gold is relatively flat, and we'll be talking about that. Oil is relatively flat. Huge moves in oil, again, as you know, over the last couple of days, but we're still above $100 a barrel. Stocks, cryptos, Bitcoin's down 7% today, so risk assets are taking a slide. Are risk assets responding to CPI, Bill, or something else?
Listen, they started moving lower off of yesterday's highs, well before the CPI number. If you look back at yesterday, it was a very low volume rally. And I'm not necessarily a bear out there. In fact, I've really highlighted value, even with you in recent months, as well as other things I've been talking about. There's value at these levels. But in the near term, we're clearly not out of the woods. And what really did that for me, finding value initially between 4,100 and 4,200 a couple weeks ago, seeing the selling on Monday, the relentless just bleed lower and selling into the close, another failed rally on Tuesday, but really it was Monday that told me this thing is not out of the woods yet. I know there's some unfinished business in the S&P down at 40.10, 40.30. There's a big breakout in the gap there. So maybe it's looking to complete that and find a bottom near the round 4,000 area.
Are you catching this falling knife, rather?
Listen, I've been looking for value across asset classes, across sectors in the equity market all year long. And we do implement hedges, and we've had hedges, protecting downside for much this year. It's given us a good ability to be patient and look for the value in different sectors. I mean, as I've been talking about with you in recent months, very overweight in energy, some material exposure, obviously, that we were overweight in. And we've monetized some of that in recent days. And I think that's definitely something you have to do after these sharp, extreme moves across those spaces. I do think tech has been just bludgeoned quite a bit. And there's definitely some places within that space that I've been looking for and allocating funds.
Okay. Now, most of these declines that you were talking about, like tech, for example, how much of that was due to geopolitical tensions in Ukraine? I'm just taking out the geopolitical premium that some other assets have been seeing, like oil, for example. We'll touch on that. How much of this decline could have been avoided if this war never happened?
I always have been saying, and I tell my clients, the correction in equity markets did not start upon Russia invading Ukraine. It really started at the end of December. The correction was in motion, for the indexes really in September through December, despite some higher highs. The stock market in general, I mean, just many stocks had topped in February 2021. So this has been taking place under the surface for over a year now. And the Fed just coming forward and taking away the transitory card on inflation and moving forward on a tighter path to hiking and quicker or speedier pace of hiking and tightening policy was what got this thing underway. And Ukraine, Russia, the geopolitics bring an added layer of uncertainty, and markets really do hate uncertainty. Now, to the other side of that coin, when markets go through corrections, they need a flush. And panic selling attributed to Russia, Ukraine can help create that flush. So I do think that where the Fed is lifting off next week and expected to hike 25 basis points, these hikes, when they lift off, the correction can really take place, for the month or 2 or 3 months following that lift off. I think that correction was pulled forward already. And instead of seeing a correction thereafter the lift off, I think we were already discounting it and seeing that correction now.
I'm looking at the Fed Watch tool, the CME Fed Watch tool. Now it's telling me that as of the next meeting on the 16th of March, we're looking at a 2.2% probability of a 0 to 25 basis point hike. And we're looking at a 97.8 probability of a 25 to 50 basis point hike. So what is it? Is it 25 or is it 50?
Well, the 0 to 25 is leaving rates unchanged, and at that point, I mean, these are the rate futures that extrapolate these probabilities. And there is some probability within that saying they won't hike. I think it's a foregone conclusion that they will. And one of the reasons why equity markets rallied about a week and a half ago was Fed Chair Powell did basically say, "Hey, there's 25 basis points is my vote," and he secured that. The meeting has become a formality since then, but it is a quarterly meeting. So what we will hear is economic projections, that dot plot that gets, is the never right dot plot. And then, and we will see some commentary on potential balance sheet runoff. Now, the meeting may come off more dovish because we're probably not going to hear a ton of commentary on the balance sheet runoff, just more on projections of where rates are going. But my fear potentially would be is if the situation in Ukraine and Russia sort of cools in the coming weeks, we're going to see the Jekyll and Hyde narrative that I talk about, where you get Jekyll during the meetings, in this case, potentially a bit more dovish, and then Hyde afterwards, where it would be a bit more hawkish. So we've got to stay nimble out there, and it's really just getting started.
So here's my confusion, Bill. This is where I was confused. The 25 basis point hike has been priced in for a while. At least people have been talking about it for months. This really should not be a surprise at this point, a week before the meeting. Why are markets still declining?
Well, the punch bowl is getting taken away, and there's definitely some fears out there. It's like I said, this correction has taken place starting in a lot of stocks starting in February 2021, and there is just no bids under some of these markets. Look at K-Web now this is not a U.S. market, but this is the Chinese tech ETF. It's basically done a complete round trip. It launched, I think it was 2013. It launched at about $26. We're back down to $26 after trading to above 100 in February of 21. That's a 75% decline, and that's not a U.S. Market, but there's obviously different U.S. sectors or some of these high multiple growth names that have just been absolutely bludgeoned. And it just goes to show you that there's this overall correction going forward that has taken place, and there's just a lack of bids underneath the market. Even yesterday's rally was a very low volume rally. So I think it's people are staying on the sidelines, and they're looking for more of a more certainty. And I think if the S&P does start breaching some serious levels to the upside, maybe above 4,500, you're going to get a run forward with people. Cash coming off the sidelines. So we haven't seen that. It's been this continuous downtrend. So from a technical standpoint, very negative, and there hasn't been any upper bands breached to encourage fresh buying.
Sentiment definitely is negative on a technical basis right now. You're right. So let's close off on equities. We'll move on to other asset classes. Are you long or short right now? Where would you be long or short given current levels and conditions?
In the equity market?
Yeah,
I'm allocated. I mean, we've been fairly allocated all year. We've raised 10 to 15% cash at times. But we've been hedged to the downside. We've been using it. I use different put structures, whether it be in the S&P, underlying S&P, or underlying NASDAQ, or underlying Russell 2000. Not so much sector based, because you don't know what sector is really, given the news flow, is going to get hit so much. So more broadly, the NASDAQ versus the S&P or the Russell 2000. But I mean, we remain broadly allocated, and it really just matters really what stocks you own. We've been extremely overweight energy. I mean, the S&P,
that's right.
Weighting of energy is 2%, probably a little more than 2% now, but we've had more than 10% exposure of energy in our portfolios. We have had nearly 10% exposure of materials in our portfolios, and these are 60-40, 80-20 portfolios. So I mean, you're talking about 60% of the equity benchmark has had basically of that, a third of that is energy and materials. We also have quite a bit of exposure to different value stocks and some defensive names. So not only consumer staples, but also actual defensive names like Raytheon and Lockheed Martin. So it really matters what stocks you own. It really has told the story of how well you've performed this year, or how poorly you've performed this year.
Okay. Well, let's talk about the energy sector. So you mentioned that you're allocated to that sector. What's your outlook on energy and energy stocks? So WTI is $109 a barrel right now, as I'm looking at the charts. Obviously the situation in Ukraine has helped propel the prices up to these current levels. At what point would you say, all right, it's time to take profits?
I've already started monetizing that. I've trimmed Chevron for the first time since, I've had clients that we were adding, this is a pretty major position, through 2021. I mean, it was trading at $80 at times. And so, yeah, I mean, I think that this move here in energy, what I've said is crude's not going to top until there's $5-10 days, and there's pain on both sides of the market. Now, I don't think the overall top in crude oil has happened, but I think this wave is pretty significant. I think it's time for it to consolidate. It's time for some of this volatility to come out of it. Now, the nice thing I think about energy names, individual stocks in general, they're benchmarked against, $65-70 crude. I just think, with a lot of things up over 100%, even if you were a buyer late in the game at the end of last year, you're up very significant right now. You're up 50 to 100% on a lot of names. So monetizing that exposure, reducing that by at least 25% or 30, or a third, makes a lot of sense. And we've been doing that. But I think this is the early innings of a longer play.
A longer play. All right, so let's assume that you think that energy is going to go even higher, and let's assume that you're long energy, okay? Would you consider making a pair trade such that you're long energy stocks and short something else? Is there a particular sector within the S&P that maybe does poorly anytime energy rises?
I mean, energy, when energy rises, it's a bellwether to the inflation narrative. And so as inflation picks up, and yields climb as inflation picks up. I mean, obviously, tech is the one that's going to be hit the hardest, and tech has been hit the hardest. Communications have been hit really hard, and now overall, I'm not sitting here saying I'm buying energy and going long tech at this point and selling
short tech.
Right? Short tech, yeah. I'm not going long energy and selling tech. I'm actually think there's too much negativity in tech. I'm monetizing my energy position and starting to put some of those funds back into tech and some of the growth names.
Do you think there's too much negativity right now in Bitcoin? We're down 7% just today?
I mean, yesterday was a good day too. I think there was definitely some negativity around it in general, but the core participants of Bitcoin, I don't think that their negativity is overall there. And there's a lot to go, within the space. I mean, you could do, on the DeFi space, there's yielding, and there's a lot of ways to of supplement, your positioning, during this time. It's not just a long play only thing. So there's definitely value within the space, and I think. If you're an investor in it, you're used to these volatile times. But I think there's definitely a reason, and I have exposure in it. I have clients on my futures side that we can use these micro Bitcoins and micro Ether. We have exposure at these levels. I think that they're pretty attractive.
Let's finish up on gold. Gold, all right, we're up a little bit today. Let's call it flat. I wouldn't call today's move a rally, but we're close to $2,000. We're at $19.93 as we speak right now, an ounce. When is it going to sustain that $2,000 level? I'm not talking about just touching it for a few hours and coming back down. When is it going to reach $2,000 and sustain that level? I'm getting old just waiting for this breakout, Bill.
Yeah, you're right. It ran into 2080 on was it Tuesday, and it's pulled back pretty significantly. And it's just an ever-present reminder, if you're looking for a free lunch and you're chasing these massive moves, whether it's crude oil, gold, or wheat, or some of the other commodities out there, you're going to get run over. And that's the clear thing out there. So what I've been looking for, and I think there was definitely some good trades to the downside yesterday, short-term wise. But what I'm looking for is in 1980 is a big level of support in gold. I don't know if that holds or not. Silver 2580 is a big level in silver. I don't know if that holds or not. And if it does, I think then the path to breaking out is going to happen much sooner. But I'm prepared for some lower levels that we've highlighted for our clients and being able to capitalize on it and looking for overall a longer term move here, because at the end of the day, we came into this year very bullish on gold, and we weren't bullish on gold because of just a Ukraine-Russia conflict. We were bullish on gold because of the fear of ongoing geopolitical confrontations, and then on top of that, a Fed at that time, January, that was extremely hawkish. So we felt that could not get more hawkish than they were. They could only become ultimately less hawkish or dovish. And at the end of the day, we've seen gold bottom at the onset or early stages of a rate hike cycle. So 1979, gold went 4x after rates hikes were kicked off. And I think it was 2004, gold bottomed in April 2004 before rate hikes started in June of 2004. And 2016, gold bottomed the day after the first liftoff. So these are times that you want to be allocated to gold. And I'm using, you can only pray for a pullback right here in order to find even better levels to be buying. Now, with that said, we want to see pullbacks hold very good construction in order to be able to build and not bring damage to the overall tape in order to stop a breakout.
Does it surprise you at all that maybe gold is not as high as it could have been? Take a look at where gold was at 2 years ago. Just slightly higher than current levels. I'm just saying that inflation has breached 40-year highs, much higher than it was 2 years ago when gold was at $2,000. So in theory, if you consider gold an inflation hedge, shouldn't gold be trading at higher levels than 2 years ago when inflation was much lower back then? Does that make sense, theoretically speaking?
Well, you're right, theoretically in many ways, but the thing is, gold has been proven not to be, an all the time inflation hedge. And I mean, I think it's the lead up is really where the question can become. So, gold rallied in August 2020, as monetary policy was just to become there was a deluge of free money that was coming out, and the market had sniffed out the direction that we were heading. But here's the problem: even though the U.S. dollar has remained pretty weak, the rise in U.S. Treasury yields has held back rallies of gold over the last year. But the thing about that rise in U.S. Treasury yields is that other major sovereign debt, such as the German Bund, remained in negative territory during that time. So the flows, I think, really hindered real flows from U.S. dollar to Europe. So if the German Bund can hold in positive territory this year, in positive yielding territory this year, I think that's going to help gold actually become a real inflation hedge a bit more than it has in the past. So that's something I'm looking at as a bellwether for a sustained move in gold this year.
Okay, so let's sum up for the audience here. Your favorite asset out of all the asset classes that we've discussed today: gold, stocks, Bitcoin, oil, the energy sector overall. Which of these is your favorite for this year, for the remainder of this year?
It'd be tough to say, even though I've been as bullish energy as it possibly could have been for the last 18 months. And even new accounts that I'm bringing in on my wealth side, it's tough to really fully allocate them into energy at this time. I mean, a lot of these people are either bringing me fresh cash that hasn't been involved in the market, or are coming from advisors that had absolutely no energy and materials exposure at all over the past year. So, so it's tough to say I'm as most bullish on energy as I can be, outperforming from here. I do think, though, that I would not be surprised one bit if from this day forward, energy does outperform through the rest of the year. But from a risk reward standpoint, I do think that we're going to see a turn in the market, and I think what could surprise is tech at this point. Now, there's not a lot of there's no actual technicals that are saying that tech is the weakest link out there. But when it has the most negativity, is really when you want to be buying. And so to speak, it's a loose term, obviously, given the war and everything that's taking place right now. And so we want to be wise in saying it, but you buy when there's blood in the streets, and tech has been the most beaten down sector. So it really is a place that I think there's the most value and the most risk versus reward at these levels.
Yeah, buy the dip, Bill. That's a popular trending meme on social media. Unfortunately, so far it hasn't worked for people trying that strategy, but hopefully you're right. It'll turn around for anybody who wants to buy the dip. Thank you so much, Bill, for coming on the show. I appreciate your thoughts. I'll speak to you next time.
Thank you. Thank you for having me.
And thank you for watching Kitco News. I'm David Lin.